Welcome to another episode of my video. In today's video, you're going to learn the institutional forex price action. So what does the word mean? The institutional are the market makers, those who control the price. They actually trade with a large volume of capital in the price. We all know what the word forex means, and price action simply means the action of price. If this is your first time on this channel, I urge you to click the subscribe button. Make sure you subscribe so this won't be the last time you be coming across this channel, and turn on the notification icon so you'll be notified each time I drop any content like this. So what I'm about to show you simply means how you can recognize institution, the market makers, we call them the market makers, or the institution action on the forex market chart through price. So this takes us to the market conditions. Now we have two types of market conditions. We have the trending or expansion market condition, and we also have the consolidation or ranging market condition. And under this trending and expansion, we have the uptrend and the downtrend. So what does these two conditions mean? I'm going to show you. Here on my left, we have the downtrend, and we also call it the bearish trend, which is the downtrend. So here on my left, this is when you see market creating series of lower highs and lower low. You see price creating lower highs and lower low, lower highs and lower low. And here on the underside, we have price creating series of higher high, higher low, higher high and higher low. Now what does this choose mean? The one on the left here simply means downtrend, when price is creating series of lower highs and lower low, lower highs and lower low. This is what we call the downtrend in the market. And here on the other hand, when price is creating series of higher highs, higher low, higher highs, higher low, higher high. So this is what we call the bullish or the uptrend in the market. And next we have the consolidation phase, when price is just ranging from one high to the other low, high, low. Price creating series of highs and low without a specific direction in the market. So this is what we call the consolidation period in the market or ranging period. So these are the two types of the market conditions we have. So now you can see, as you can see on the screen here, you see that there will be a particular time where price will just break out of the range, and price will just go to any specific directions price wants to go. And most people just do away with this kind of market conditions because it's actually tricky, because during these times the market makers build up liquidity at this point. So when they build up enough liquidity, they will now break out the price to go in their intended direction, because sometimes the trick the retail traders, as you can see here, you can see that the price went down, see if price want to break out of this range, and immediately after that we see price reverse, go up and started trending to the upside. So that's part of it. So that's the reason why most professional traders stay out of the ranging market, because it is very difficult or very risky to trade. So you just want to go with the trend, you just want to follow the trend. So now I will show us a real life chart example. Now take a look at this. Here is a real chart example. As you can see, price is creating series of higher highs, higher low, higher high, higher low, higher high, higher low, higher high, higher low and higher high. So this is what we call the uptrend market, or we call it the bullish market. This is when the buyers are taking over the market. This is a real life chart example. If you look here, you see price creating series of lower highs and lower low in the market. This is a real chart example of the downtrend market, when price is creating series of lower highs and lower low. You see price creating series of lower highs, lower high, lower low. You see price creating lower highs here, we have lower low, we have lower highs here, we have lower low, we have lower highs here, and price now creating new lower, we have price creating new lower low here. So this is a real chart example of a downtrend market or a bearish market. Now take a look at this. You see price creating, just ranging within this range. price ranging, is moving to the upside and downside at the same time without a specific direction. You see, price just ranging in this range, price just moving up and moving down without a specific direction. As you can see, this is the market condition. This is what we call the consolidation period in the market, or the ranging market conditions. As if price wants to go up here, price drops down, could move up, drops down, move up, drops down, move up, as if price wants to break out here. As you can see, they are trapping people to get in the market. And you see, when people are buying here, they push price down, because some retail traders will think like price have broke this high, so they will think price has broke this high, that price is ready to move up. And you see what happened next? Price pulled back inside of the range, took out all their stop loss here, and price did what again? Why some people will feel like now price is ready to sell, and people will start selling at this point. And you see what is happening again? Price is going up again. Maybe the next few hours or few days, you see price going down again without a specific direction. So most professional traders really stay out of this kind of market conditions. So I personally, I don't trade in this kind of period in the market. I stay out of the market. I wait till I have a clear confirmation in the market before I trade. So if you have any question, you just write down in the comment section. I'll be going through all the comment section, answering all questions you have. And if there's any topic you want me to cover next on this channel, write down in the comment section as well. And I also will be dropping a free signal in my Telegram channel. So make sure you join my Telegram channel. You'll see the link to my Telegram channel in the description of this video, and all my social media on this, to get free signals. And I'll be also be dropping more advanced content like this. So here I want to show us the external and the internal points in the market chart. So as you can see, on the left side we have the downtrending market. We have market trending to the downside, and on the other side we have market trending to the upside. Now, where are the external points and where are the internal points in this kind of market chart? Now, if you look here to the left, you see that this low, before price broke this low, this high is the highest price point price ever reached before breaking this low. So this becomes our external high. Our highest price point before breaking this low becomes our external high. Take your Fibonacci, apply it from this low, and take it to the highest point, this high. If you mark it to that high, this is just the default Fibonacci settings. So you can see that from this low to this high, here is the highest point price has ever reached before breaking this low. So immediately price break this low, you can see this is the highest point price create before price reach before breaking this low. So this becomes our external high. Then we have price creating another high here before breaking this low. You can see before breaking this low. So this high is what we call the internal high, because this is not the highest point price ever reached before breaking this low. So this is an internal, while this is an external high. Now, and we also call this the internal high, we call it macro. We call it the macro high. And the internal low, we call it the micro. Other names for it is for the internal high is micro. Now as you can see here, same thing happens here. We have price pulling back from this point, and price creating series of highs, low, high, and went down to break this low. Now where's the highest point price reach before breaking this low? Here's the highest point price reach, and this becomes our external high, because this is the highest point price reach before breaking this low. So this is our external high. Now let's look here. You can see price started reversing from this point, went up, dropped down, and went up, creating a series of lower lows. You see we have another lower lows here before breaking this low here that we have here. Now where is our external high? This point becomes our what? This point becomes our external high, the highest point price reach before breaking this low. Now all these highs are just internal high, and you can also call them the macro point, micro, and this point becomes our macro, the external. But these two highs that you see here, they are just internal high or the macro high. Now let's look at the uptrending example. In an uptrending market, you see here, before price actually break this high, so this low is the lowest point price ever reached before price broke this high. Now let's look, where is our internal low? As you can see, because when price started reversing from this low, price went up here, dropped down a little bit and started going up. As you can see, this low becomes our internal low. This is not an external, this is our external point. If you take out your fib from this high up onto this low, you can see this low here. You can see that from this high to this low, you can see this is the lowest point price ever reached before reversing to break this high. So this becomes our what? Our external low, as you can see. Now let's look at the second example here. We have price reversing from this point, drops down and went up again. So before price broke this high, this is the lowest point price ever reached before price breaks this high. So this becomes our external low. And we have another example here when price started reversing from this point, went down to this point before reversing and creating series of highs, low, and high. Now this point becomes our external low, because this is the lowest point price ever reached before breaking this high, and these other two lows here are just internal low or the micro low, and you can call this the external low or the macro low. I hope you understand. If you have any question, you can ask and write it down in the comment section. I'll be answering. You can also follow me on my Instagram. So I need to reach 100k Instagram by the end of this year. I know it's possible with you guys, and because I'll be doing a lot of giveaways and sharing a lot of more useful content like this. So here is a real life chart example of the micro and the macro price point in the market. And as you can see here, you can see this blue bar represents the external point, which is the macro point, and this green point here, as you can see, represents the internal point or the micro point in the market. Now let me explain this quickly. Immediately price broke this high. If you take your fib from this point just to this low, from this high to this low, you see this is the last low that we have that price reached before breaking this high. So this becomes our what? This becomes our external low, which is the lowest point price reached. And we have these two lows we have here before price broke this high, and these two lows are called the internal low. This is not the external point, this is just the internal low. So this is how the this is how price is moving. And if you want to draw on the high time frames, you'll see price moving this way on the high time frames, from this point to this point, from this point to this point. When you switch to higher time frames, this is what you're going to see. So next year, you see from this point price broke this high, and immediately price broke this high. This is the lowest point we have that price reached before breaking this high, as you can see. So this becomes our external low, and here is our external high, and this is our external low, so on like that. And we have our internal low here, which is another low that has been created here before we broke this high. So this low is just an internal low, this is not an external low. Same thing happens here. We have our external low here. Immediately price broke this high. Now we have our external low here. This is the lowest point price ever reached before breaking this high. And same thing also happens here. So immediately price broke this high. This is the lowest point price ever reached before breaking this high. So this is our external point, and this point that you see that have these black dots are the internal lows these are the internal lows in the market. Same thing applies to a bearish market. Quickly, I would like to talk about the broker that I use. I use SNS to trade in market, and this is the broker that I would like to I would recommend for you all to trade with. So they have the best they are the best performing broker at the moment, and I will drop the link for you to sign up or to register in the description of this video, and you can also check out the link in my Telegram channel. And also, if you have this account already, send me a DM on Telegram and message me on Telegram if you have this account already. Now, the next thing I want to explain here is the difference between time frames, because especially for the newbies who don't know how this time frames works on the chart, because sometimes you see on the chart when you're on the higher time frames, you see price creating big candles, and when you switch to the lower time frames, you see price creating a bunch of small candles with a trend. Let me show us what happened. Now, if you look at this chart right here right now, you can see the time frames here is the 4-hour time frames, and you can see candle creating series of candles to the downside. We have price moving to the downside. Now, it actually takes the next 4 hours for you to see the next candle to form on the chart when you switch to the 4-hour time frames. But when you switch to the lower time frames, it will take the next 15 minutes for you to see the next candle to form on the chart, as you can see here. Look at this candle. You see this candle, within the next 1 minute and 57 seconds, this candle will close and we have the next candle open. But when it's on the 4-hour, it actually takes the next 4 hours. As you can see, it takes 3 hours and 30 minutes for this candle to close and for the next candle to open. That's the reason why you see little candle on the higher time frames, and you see just a bunch of candles, many candles on the lower time frames. As you can see, look at these two candles, this little drop. If you take a look at this little bearish move to the downside, if you take a look at this on the lower time frames, maybe like the 15 minutes, you will see price creating series of lower highs and lower low, even price range at some point here. Price range here broke out of this range and started trending to the downside, as you can see. But when I switch to the 4-hour time frame, we see just little moves. The difference between this is the time frames, and what happened is because the time frames within the candle close and the candle opens, so that's why you see on the higher time frame you see price just creating series of little candles on the higher time frames, and when you switch to the lower time frames, you will see price ranging, creating a trend. So this red line signifies the higher time frames, and this green line, this black line stands for the lower time frames, as you can see. And you see the candlesticks, the bearish candlesticks open at the top and close at the bottom, and the bullish candlesticks open at the bottom and close at the top. So that's just the difference. So when you are switching between these time frames, so it won't be like maybe something different is actually happening. No, nothing different is happening. As a day trader has a particular time frame in which they analyze market, and they have a particular time frames in which they execute the market. So as a day trader, most day trader analyze the market on the 4-hour, and they execute on the 15 minutes. The reason why is that when you analyze on the 4-hour as a day trader, you'll be able to determine where price will go for the next, at least for that day and even for a few weeks. So you can just scale down to the lower time frame so that you'll be able to minimize your risk to lower time frames and have your entry. Because when you are entering on the 4-hour time frames, you might be having a bigger stop loss than when you are executing trade on the lower time frames. So that's just the difference between these time frames. Now the next here is I would like to explain the difference between these two types of market structure. As you can see here that here on the left side we have price creating series of lower lows and lower highs, lower low, lower highs and lower low, lower highs and lower low. Now And the same thing on the other side, we have price creating higher as higher low, higher high, higher low, higher high, higher low, and higher high. Now, what's the difference between these two? Because most people believe this kind of market conditions, this kind of market structure is what we call the supply and demand market structure. Yes, these two type, they believe this is what we call the supply and demand market structure. Why some traders believe that this kind of market structure is what we call the support and resistance market structure, which is not true. Now, when you look at these two, I would like to explain and tell you the difference between the two. But before I tell you the difference, I just want you to know that this you can call this the support and resistance. You can also call it the supply and demand. And this kind of market structure, you can call it support and resistance. You can also call it supply and demand. Because the reason why is that, look at the definition of what supply and demand means and what support and resistance means. You see that when there is high demand for a currency pair, more buyers than sellers, the price will do what? The price will rise. When there are more people demanding for price is going to rise. And conversely, when there is high supply of one currency pair, more sellers than buyers, the price will fall. When we have more suppliers in the market than demand, what will happen? Price will fall. On the other hand, we have support and resistance indicates areas on the price chart where buyers or selling pressure is likely to occur. Support is the level where buyers are expected to be stronger enough to turn a downtrend. Resistance is the level where sellers might be able to reverse an uptrend. Now, what this simply means is that at a particular point in time where the sellers are able to turn a uptrend to a downtrend, that's what we call the resistance. And at a particular point where the buyers are able to turn a downtrend to uptrend in the market, is what we call the support. You can see here what's the difference between these two. That's what I want to explain. So you know that these two you can call it the same thing. Now, when you take a look at this low, you see, take a look at this low and look at this high and this low. Now, you see, when price started retracing back from this point, price have a deeper retracement into the previous range. This previous range, which is here, you can see the range from here to here. We have a deeper retracement into this previous range. Likewise here, when price broke this low, we have a deeper retracement into this previous range before breaking this low. And same thing also happens here. When price retraces here, we have a deeper retracement into this previous range before price broke this low. Now, you can also call this low, you can also call this range the order flow, because this is the last point where buyers have started buying before the price started selling. So you can call this your order flow from here to here, from this point to this point, this high. You can call it your order flow. Yeah, you can also call it your order flow. But here on the other hand, you see price does not reverse deeply inside of this range. In fact, price just mitigated this previous range and started doing what? And started dropping, started selling, and see, and started to sell. And same thing here, after price broke this high and went down just to mitigate this previous high. And what happened? The trend changes and price started to go up. So that's just the difference. We have a deeper retracement here, but we never have a deeper retracement here. So what I try to call this, because sometimes the institution want to fulfill their orders, as you can see here. Sometimes they want to fulfill their orders, so that's why they push price back to where to their initial orders where they started selling. So they just put price back to fulfill their orders, so to now push price to continue in their direction. Or at times they also like to sell and buy from a discount or extreme level in the market. So what do I mean about a discount or extreme level in the market? when you take a look at this from this point to this point, we have price retracing here up onto this point, this red zone that I draw here, before breaking this low. So what this signifies is just that this green, this black area signifies the discounted area, and this red area signifies the extreme. Because at a point in the price, so let's say dollar is being sold here at $1, and here at $2, here $3, and here $4. So the institution will wait till price get to this point so that they can sell at a higher price. They won't sell here, they won't sell here, they won't sell here. So they wait for price to reach here. So here they will be willing to sell here because price is high at this point. So they will be willing to sell at this point, which is at a premium area, and you can call it the premium or the extreme here. So they will be willing to sell it here. So they won't want to sell here when the price is low. So also, in the other hand, from this high to this let's say, if you look here from this high to this low, we have a deeper retracement back to the extreme point, which you can also call the discount point. The extreme point here, the extreme. Although this black bar, you can call it the discounted area, because immediately price crossed the 50% area, we are at the discounted area, because sometimes the institution start purchasing price from the 50% discounted area up onto the extreme point. So when price gets here, price is much cheaper here, because let's say dollar is being sold here for $5, and dollar is being sold here for $4, $3, and here $1. So they would like to push price down so that they will be able to buy and purchase dollar at a cheaper price. And after purchasing dollar at a cheaper price here, and price will do what? And price will start going up again. So that's just the difference between these two. So they like to at times they like to purchase price at a discounted area or an extreme area, and sometimes they like to feed their orders. So that's just the difference between these two. I hope this explained it, and if you have any question, don't forget to write it down in the comment section. I'll be answering all questions. So I will show us a real chart example of what I just explained now. Here are the supply points in the market when price broke out to mitigate the previous extreme point in the market. As you can see, after price went down here, after price broke this low, we have price breaking this low. So immediately price broke this low, price went back to mitigate the extreme point before doing what? Before going down to the downside, because here price is oversold. So people, so the institution will like to sell at this point, because this is an extreme premium point in the market where price is very extremely high. So this is where this is why they like to push price to the extreme point before selling in the market, just to make, I don't know, maybe just to make more money for them, or maybe let's just say just to make more money for them. And see, the same thing also happens here. As you can see, we have price here. After breaking this low, you can see price went back to this high, to the premium point. As you can see, price get to the discounted area, immediately price break this 50% Fibonacci level. You can see price started retracing from this point up onto the 50% level, the Fibonacci level, and now price also get to the extreme point. Until price get to the extreme point here, and price started doing what? Price started selling to the downside, creating new lower low. As you can see, because at this point price is very high. So this is where the institutional starts telling the price, and price doing what? Price trending price started selling to the downside. So let me just label this. So as you can see, here are the extreme discount points in the market. We have here at the extreme in the other hand, and in the bullish market, here becomes the extreme point, and we have the discounted point. Immediately price gets to the 50% Fibonacci level, we get to the discounted point. So here is a bullish market example. As you can see here, after price broke this high, we have a deeper retracement to this low before price broke another high, as you can see here, and we have price going down, trending to the downside to an extreme point from this high to this low. Now look here, from this high to this low, as you can see, we have a deeper retracement from here to the 50% discount level. Price move up a little bit and go to the extreme point before price did what? Go here, went down one more time and started going up to the upside. So that's what happens sometimes in the market. Price have a deeper retracement, maybe to fulfill the orders, or to went to a cheaper level in the price where they were able to buy more of a certain currency pairs in the market. So this is what actually happens. And you see here, same thing happens here. Price went up, went down even more to this level, and price started going up again. So here is the last example I would like to share. As you can see here, in this kind of market conditions, you can see price just breaking lows. So immediately price broke this low, you see price mitigates this previous demand level, drops to downside, went up again to mitigate, drops, went up again the third time to mitigate, without going back inside of this range. We have no deeper retracement inside of this range, or we can call it the order flow, inside of this order flow, before price started selling again to the downside. And the same thing happens here. After price broke this low, price mitigates this order flow, drop to the downside, and mitigate the order flow one more time and drop to the downside. We did not have any deeper retracement. Let me just take out my feed one more time. As you can see, from this low to this high, as you can see, from this low to this high, this is the highest point price ever reached after breaking this low, and price started retracing from here. We also have other points where price retrace, but here we have a deeper retracement here. And as you can see, even when price have a deeper retracement from this point, you can see that price gets to the discounted point here, which is the order flow. After reaching this, mitigating this order flow, what happened? Price started selling. We have no deeper retracement into the extreme point in the market. As you can see, immediately price broke this low. You see, we did not have any deeper retracement back inside of this order flow or this range before price continued to the downside. As you can see, price just mitigate this low. This demand level, this previous support or demand level. And what happened? Price started selling. Price broke this low, and after broke this low, price went back up multiple times, mitigate this order flow here, and drop back to the downside. As you can see, we have no deeper retracement. So this is just the difference between the two. So I hope you understand the terms what supply and demand means in the market, and the other words for demand in the market is also called support or the floor, and the other word for supply in the market, we call it resistance or ceiling in the market. So I hope you understand, and if there's any question you have, don't wait to ask. Write it down in the comment section, and make sure you like this video if you've learned something today, and make sure you share it with your loved ones, and also subscribe to this channel. Turn on the notification icon so you'll be among the first of top people to be notified each time I drop a new content like this. So to watch the next episode of this video, at the top right corner of your screen, you see the video pop-ups. Click it to watch the next episode. Until the next video, peace out.